you can't make up what you've lost. One of the most important statistics is that the best month of the year always follows the worst month of the year. And so we show our clients in various ways. Like if you try to time the market, you're likely to miss that massive rally like we had yesterday because you were so fearful of what was going on from June and July. The favorites were underperforming.
People have done studies.
Tech was over. I mean, essentially, if you go back 30 years and you miss the best month of the year, you're underperformed by 500 basis points.
I'll go to Capital Group out in Los Angeles who've done great studies on this. You got to be in the market. We all know that. But you were weaned at Chicago, the land of fama and French, where you have to play. You discuss that.
As my 3 male children would tell me, you miss all the shots you don't take. And I think there is, as you say, it's a disease of trying to time the market. I'll say this, people can be pretty good at selling more or less near local peaks, right? Well, you can see deterioration. You can see it. Percent of S&P with advanced decline lines.
Right.
You can kind of see, you could be headed into a nice little sell-off or consolidation phase, whatever you want to call it. And then you never get back in. And that's the issue because the lows are ugly. If you think about last Thursday, it just looked like the apocalypse. Actually, it turned out to be a clearing event. And, Citadel did great on that, but I'm sure a lot of people were selling right into it. And it's too emotional. It doesn't matter how many years you've been doing this, but people fall for it at the same time. You're not going to save yourself anything. You're going to damage your forward returns. The only time you really want to think about the next 12 months possibly being lower is if you think a recession's coming. We haven't had a proper recession since 2008. The one in 2020 was man-made. Okay?
That's stunning.
The market since 2010 is up 14% annualized, okay? That includes the 25% sell-off in 2022. That includes the down 6% in 2018. So trying to time it it's fruitless. It's from a different era when you actually had recessions every 5 to 7 years, and coming out of the market perhaps saved you some losses. So, the most important thing is there a recession looming? This market, this economy, there's no recession. And by the way, the banks are doing terrific. Yep. When banks do great, you're not going into recession. They're the forward-leading indicator.
Technology, AI, focusing on returns on AI CapEx. How do you guys think about that theme right now?
So I think that's the most important theme in the market. And that, of course, was the clearing, was the earnings that we had from some of the hyperscalers. Even where the market was disappointed in some of the others, the revenue was going much higher on the cloud business. And what we saw was the one question, there are two questions. Can equities rally with the 4.5% bogey on the 10-year being breached, right?
Yep.
And the answer was actually it was kind of fine. It was fine. Yep. Okay. So that question was answered. So look, yields probably could get to 5% here simply because between the inflation numbers and, from the questioning of the Fed's reaction function and the uncertainty in Iran, the Iran war. So that's number one. But equities are fine. The second big question is the ROI on spending. And that could have killed the entire market. Okay. You would have wound up with healthcare, utilities, and staples working. And the answer is actually the business model is working, even if free cash flow is going negative in the short term, even if they have to sell debt to fund it. They're reaccelerating the core business, which is cloud. And so it's working. And once you answer that question, you're off to the races. The whole complex can rally.
Alicia Levine with us, BNY. Thrilled you're with us today across America, around the world. Futures up 28. Paul, I ask a question here because I got to go nerd here in a moment. Paul Sweeney with Alicia Levine.
Alicia, you say industrials, attractive entry point. And we had great numbers out of Caterpillar yesterday. So, boy, that's a great timing.
So you have it's a perfect storm. Okay. You have the CapEx incentives from the One Big Beautiful Bill, which are rolling through the economy and are definitely helping hard assets, that's industrials, as well as the funding from the hyperscalers. So if you think about what you need to build a data center or what you need to to build out the AI on the hard asset side, The projections for next year is $1 trillion in spending. That is going directly into the P&L of 20% of the S&P. So that's why we like it. I mean, industrials have been actually the best sector of the year. We think that continues.
So give us your targets here quickly.
Okay, 8,000 with risk to the upside.
8,000.
Yeah, but risk to the upside here. Right.
Okay.
Forward earnings are growing at 30%.
Okay.
Jeez.
The multiple's lower than it was June 2nd when the market peaked before.
If I look at two sets of difference equations on the x-axis, and I look at all this CapEx, all these tech companies are spending, and matched against that is the same timeline of their huge cash flows and profitability, I say they've only got to go out 1 quarter, 2 quarters, 3 quarters, 4 quarters after that CapEx expense to be made whole.
Yes.
Is that in the zeitgeist now? I don't think so.
So we've been running models on it, and it looks like they return to cash flow positive in about 18 to 24 months.
Okay, so that's 6 quarters,
and then it explodes again. Then it explodes. Then they become the bond.
Wait, whoa, positively explodes.
It explodes. The cash flow becomes positive, and then it explodes to the upside.
So what's your...
Because they're monetizing the investment.
You're the first one who's done this. Thank you. What's the fan distribution of outcomes 24 quarters, whatever?
Okay, let's call it, we're in 2026, let's call it 2029. So you're looking at about flat 28 to 29, and then it explodes by 2030.